Hey there, my name is James Lee. Welcome to another segment of 5149 on Breaking Points. And today we're going to talk about inflation and the core rot underlying the American economy.
Gas prices are now at a level we have never seen before. Overnight, AAA reported the nationwide average for a gallon of regular reached $5. That's up nearly $2 from 1 year ago.
And now to growing concerns about the economy, and that includes the increasing pain at the pump. I want to show you this. A gas station in downtown LA, look at that, topped $8 for a regular gallon of gas.
That's right, gas is at an all-time high, and the increase seems more permanent than temporary. Supply chain issues are becoming more frequent, more disruptive, highlighted by the recent baby formula shortage fiasco. There's definitely this feeling of uncertainty, anxiety, unrest, so many troubling indicators that what's to come is only going to get worse. And I, like many of you, desperately want to know what's going on, why this is happening, and how we can fix it. And many of us will, of course, turn to the media to provide such insight to help us understand what is going on with our country.
Tonight, Americans are reacting to the soaring price at the pump, the national average overnight reaching $5 a gallon for the first time ever. President Biden again today putting the blame on Vladimir Putin's invasion of Ukraine and saying the administration is pushing to do more.
Inflation is a real challenge to American families. Today's inflation report confirmed what Americans already know. Putin's price hike is hitting America hard.
Well, first, the president's come out with his plan to fight inflation. It's not a plan. It's an embarrassment. If a high school kid turned that in as an economics paper, they'd get a D-. But for a president to say that at the time of record high inflation for prices, for gas, for groceries, he deserves an F because it's full of finger pointing, false accusations. And Maria, he takes no responsibility for his economic malpractice, because that's what this is.
I have this fundamental view that much of the inflation has been generated by some very large policy shifts in the United States. We changed our immigration policies, and I'm talking about legal immigration, okay? We're down 2 million. 2 million new entrants to the United States legally. That is very inflationary when we have full employment, when we have these jobs. Think about all the need for workers. What does that going to mean when we start implementing our infrastructure bill, when it's going to take up quite a few new jobs? Where are those employees going to be coming from? It's going to create rising wages. And if you look at earnings, many companies are saying rising wages are a part of their degradation of their margins.
So the mainstream media coverage once again has been predictably shallow. Right? Biden is blaming Putin for price hikes. Republicans are blaming Biden for economic malpractice. And corporate executives like Larry Fink of BlackRock are blaming the lack of low-wage immigrants. And I have to acknowledge inflation is a very complicated topic, and there's plenty of criticism to go around. Yet I find the mainstream and corporate media's coverage of this issue to not be very helpful in explaining or exposing the fundamental rot at the heart of the American economy. There are certainly some root causes and discussions that receive little to no attention from the corporate media, perhaps ignored on purpose. Take the oil market, for example. Pre-COVID in December of 2019, global oil consumption was about 100 million barrels per day. But in the immediate months after the pandemic hit in early 2020, demand dropped to below 90 million barrels per day. Oil demand has since recovered and is forecasted to exceed 2019 levels by Q4 2022. The global supply of oil, however, has lagged and is expected to continue to lag at least until next year. Now let's take a look at prices. Before the pandemic, the price of West Texas Intermediate WTI crude hovered around $50 to $60 per barrel. In early 2020, in the immediate months after the pandemic hit, prices collapsed, at one point dropping to below $20 per barrel, but has been on a steady climb ever since, now to almost $110 per barrel. I also just want to say really quickly that I understand that with oil and gas, there is a climate and sustainability consideration. We absolutely need to invest in newer, more sustainable technologies, but I want to put that aside for one moment and consider this issue from the lens of basic economics, which is that demand for oil has recovered, but the supply still hasn't caught back up to that demand causing prices to inflate. President Biden has already called upon the oil sector to hike production. Quote, "We think these companies need to be stepping up," a senior administration official said in a background call with reporters. "There is nothing standing in their way." So why don't oil companies want to produce more? After all, they are flush with cash, and at the current prices, there's a lot of money to be made. To fully understand this, we need to walk through two important metrics companies use to make capital allocation decisions: IRR and hurdle rate. IRR stands for internal rate of return, and it represents how much return the company expects on any given project that they're evaluating. The hurdle rate is the minimum acceptable rate of return a business requires on a capital project, oftentimes represented by something called WACC, weighted average cost of capital. To put it in the simplest terms possible, if the return on a project is expected to exceed the required cost of the investment, then it makes sense to move forward. But if the return is less than the cost of the investment, then it doesn't make sense to move forward. So one would expect right now, with the supply and demand fundamentals of the current market, it would be a no-brainer for oil companies to invest more into drilling to capitalize on these higher prices. Sounds logical, right? But here is the reality that the media oftentimes chooses to ignore for whatever reason. According to Julius Krine's paper entitled "The Value of Nothing: Capital versus Growth" in the intellectual journal American Affairs, quote, "Today's shareholder-driven corporations are not necessarily or even primarily motivated to engage in the traditional methods of growing a business. Companies are often highly incentivized to pursue financial engineering and valuation multiple expansion rather than invest to increase earnings. Eliminating profit streams can actually increase shareholder returns when the remaining company trades at a higher valuation, especially if share buybacks or other cash returns feature in the process." So what this means is that even in situations where it might be profitable, shareholders prefer that companies return cash to them rather than invest it in projects with a longer-term time horizon. How rotten is that? Companies will pass up investments that would create jobs and opportunity for people and would grow their profits just to put that money back into the shareholders' pockets. And that's exactly what's happened here with oil and gas. According to recent reporting from Bloomberg, big oil spends on investors, not output, prolonging crude crunch. The second highest cash haul ever has not been enough to spur investment, and wary the tide will shift again. Major companies prefer to reward investors. Let's walk through some of the charts in this article because I think it's very revealing. First, Western super majors like Shell, Total Energies, BP, ExxonMobil, and Chevron just reported their second highest cash flow ever. But in terms of their spending, it's half that of 2013 when crude oil last topped $100. And companies like Exxon and Chevron are spending more on investor returns than on production, with the companies spending more in recent years on stock buybacks and dividends than capital expenditures. So these oil companies are flush with cash, investing less of it, giving more of it to shareholders, and many of us are stuck dealing with the pain at the pump. And maybe even more revealing, let's take a look at how it's being portrayed in the corporate media.
Food at grocery stores up 11.9%. It's the highest increase since 1978. We also know that the war in Ukraine really pushing up prices for a lot of wheat products, so cookies and pasta. So, what the problem is, and you'd say, I'll eat cheaper tonight,
Right.
Rice and beans. And you know what? Everything is more expensive.
Everything is more expensive. I can't find anything that is less expensive. The Dow is now down 9 of the past 10 weeks.
Classic panel discussion going on here. Yes, food is more expensive, and many can't afford to eat. Gas is more expensive. Everything is more expensive. But the Dow, what do we do about the Dow? That is, unfortunately, more or less the type of discourse that you're most likely to find in mainstream media. Americans are struggling, but what about stocks? Krine continues in his paper, quote, "From the standpoint of economic theory, this represents an irrational refusal to maximize profits. But with regard to maximizing equity value, it is an eminently rational strategy. Lowering hurdle rates would mean investing in projects that might increase earnings, but which would likely degrade earnings quality. In other words, metrics like return on assets would deteriorate and valuation multiples would probably fall. Avoiding such investments and instead returning cash to shareholders to further prop up valuations becomes a preferable approach to maximizing shareholder value, even if it forgoes substantial profit opportunities. But if the link between shareholder value and profits is severed, then the justifications for shareholder primacy and much else in economic theory collapse. I think the word collapse is too often used hyperbolically, but in this case, it's an outcome that is legitimately looming on the horizon if we don't make some changes, because the rot we've just discussed is present in not just the oil and gas industry, but in every industry. In order to financially engineer better valuations, better multiples, better earnings, better whatever new vogue metric that Wall Street happens to care about, pharmaceutical companies are outsourcing production to overseas manufacturers. Computer chip manufacturers like Intel are letting a direct competitor produce semiconductors for them. Aerospace manufacturers can market and sell commercial aircrafts that they neither design nor built. I could go on, but these decisions compounded will lead to the imminent and self-inflicted collapse of America. Here's the data to back this up. According to a paper from the National Bureau of Economic Research, quote, from 1989 to 2017, $34 trillion of real equity wealth was created by the US corporate sector. We estimate that 44% of this increase was attributable to a reallocation of rewards to shareholders in a decelerating economy, primarily at the expense of labor compensation. Economic growth accounted for just 25%, followed by a lower risk price, 18%, and lower interest rates, 14%. The truth is, multinational corporations aren't beholden to any country or community, and they don't have a moral obligation to society. The only obligation is to transfer wealth to its shareholders. And in tough times, the majority of that wealth transfer comes at the expense of either labor or the expense of consumers, right? Building something like a robust and reliable supply chain takes investment. But as we've seen recently, it's also critical in maintaining the stability and wellness of our society. In contrast, the period 1952 to 1988 experienced less than 1/3 of the growth in market equity, but economic growth accounted for more than 100% of it. But of course, everything is a trade-off. Do we want to incentivize a financialized economy where we optimize for shareholder returns and things are fantastic so long as you're one of the shareholders? Or should we return to an economy rooted in longer-term thinking with significant structural investments in jobs that can sustain everyone in America from top to bottom? You know, the core rot, as exemplified by the oil market trends, is that the American economy is structured in a way that radically benefits just a few large shareholders at the expense of everyone else, particularly the working class. And my final point, I just want everybody to remember this, is that when you hear members of Congress, CEOs, or the mainstream media hail the private sector as the savior to our economic woes, it's because they oftentimes are the shareholders of these companies and profiting quite handsomely from their investments, without, of course, actually creating any real value at all. Maybe even worse, the media pundits that are out there almost never disclose their conflicts of interest to their viewers. Thank you so much for listening today. I hope you enjoyed today's discussion about one aspect of what's wrong with America's economy that just isn't talked about enough. There are many more, so if you'd like to know more about this topic and many others, please check out my channel 5149 on YouTube, where I release weekly videos relating to the intersection of business and politics and society. The link will be in the description below. And of course, subscribe to Breaking Points. And thank you so much for your time today.
Cable news is ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.